The United States has deployed a naval and economic blockade designed to completely choke off Iran's oil exports. Against almost any other nation, this level of economic warfare forces total compliance. The global market simply stops buying. But there is a massive geographic loophole in the Persian Gulf that bypasses these sanctions entirely. That loophole is China. This flow data visualization shows the scale of defiance. In the pre-war period, 80 to 90% of Iranian oil exports headed directly to Chinese refineries. Those flows terminate along the coast, feeding independent teapot refineries, processing discounted, sanctioned crude. For this blockade to remain credible to the rest of the world, Washington has to force Beijing to stop those flows. Instead, the U.S. watches these tankers transit the blockade, taking no action to stop them. Every shipment that passes through unchallenged is a public demonstration of the limits of American global power in 2026. Beijing's refusal to comply is encoded in a 25-year comprehensive strategic partnership. Abandoning that commitment under American pressure would shatter Xi Jinping's global strategy. The Chinese economic model relies on these affordable energy inputs. Their coastal teapot refineries are physically optimized for Iranian blends, and restructuring that sector would come at a massive cost to their downstream industrial economy. Beijing has also spent years building a financial architecture to bypass the US dollar, using non-Western insurance and payment channels specifically for this scenario. They evade US banking oversight entirely by using yuan-denominated oil trades, barter arrangements, and physical gold settlements. To yield now would signal to Russia and the global South that Chinese commitments break under US pressure. Beijing wants to be seen as a reliable alternative to an unpredictable America, not a subordinate. Because this relationship is structural rather than transactional, it is inconceivable that China will stop its purchases just because Washington demands it. On paper, Washington has the power to act. They could sanction the teapot refineries, interdict the tankers directly, or cut off any Chinese bank that processes Iranian transactions. If these economic weapons are available, why does the U.S. keep them holstered? Because of the escalation ladder. Any direct U.S. strike on Chinese commercial interests triggers a retaliatory response that terrifies policymakers in Washington. Beijing can respond by dumping U.S. treasuries, intensifying the trade war, or weaponizing its currency to destabilize the American economy. They could also restrict the export of rare earth minerals, which are essential to both the U.S. tech sector and the defense industry. And at the top of the ladder, China can apply immediate, extreme military and political pressure directly to Taiwan. The U.S. is boxed in. Successfully stopping Iranian oil flows isn't worth the risk of triggering a mutually assured economic meltdown with China. The result is a quiet continuation of the trade. Chinese tankers are still transiting the strait in reduced numbers, while refineries draw on strategic reserves to absorb the initial shock of the blockade. This projected recovery shows that within 2 or 3 months, the Chinese will likely be buying as much Iranian oil as they did before the war, simply using adjusted channels and updated plausible deniability. This persistence reveals that while U.S. leverage over Iran is still massive, its leverage against a major power like China is now entirely contingent. Washington can bluff and apply pressure through proxies, but it blinks whenever a core Chinese interest is directly challenged. Sanctions regimes depend on the credibility of their enforcement. Every time the U.S. is seen accepting Chinese evasion, that credibility degrades further. This standoff reveals the emergence of a two-tiered hierarchy. We are moving toward a world where the U.S. can effectively enforce its rules against weak countries, while China remains functionally exempt.